I'm Peter Rutter. I'm one of the senior PMs at Lifecycle. What are we all about? Well, we're all about differentiated stock picking and then combining that differentiated stock picking in very balanced, very core portfolios, balanced across style, sector, region, and other things besides that. Now, the reason for that is that if we can get the stock picking right combined with that balance, it gives us the potential to generate an alpha stream for our clients across multiple market conditions, irrespective of what's leading the way at that moment in time. Indeed, that's something we've done for over 20 years together as a senior investment team, and it's something that we've delivered on with market-leading alpha and a consistency of alpha. So, for example, our longest-running strategy's beaten the market in 20 out of 23 years it's been going, and in the last 5 years across our strategies, we were able to deliver first percentile alpha, but also first percentile risk-adjusted alpha and consistency of alpha simultaneously. Coming across to Lifecycle, which we started in July, nothing's changed around the core investment team or the process, but actually the big change has really been joining and entering the multi-affiliate model that Pinnacle provide, which for the best of both worlds of a boutique investor-led firm, but combined with that resource and scale and support of Pinnacle, we think is an optimal structure within the industry to support our repeatability of the past, but also our potential going forward. So delighted to be here, and also to say that already in 7 months, we're firmly established with clients across institutional and wholesale and a critical mass in our business. So it's been a busy 7 months, but it's been great to get that support and start working with Pinnacle. So that's a bit of intro. I will get into a few things just for because I guess we're new to the party, so useful to do that intro. And I'll talk about what the corporate lifecycle concept is. I'll give some stock examples to demonstrate how it's useful to us when we pick stocks, but perhaps hopefully more interesting, I'll also talk about the opportunities we're seeing out there in global equities across the different lifecycle categories at this moment in time. So, the corporate life cycle, so important to us, we put it in the name. What is it? Well, it's this observation that at the individual corporate level, returns on invested capital and growth tend to progress along this pattern on the chart behind me. So on the left-hand side, you get, the return on capital is shown with the wavy line on this graph. You get disruptive, innovative, early life cycle companies. It's expensive and difficult to disrupt and innovate. They often make low returns on capital. They may even be loss-making initially. But if they're successful with disruptive, innovative products and services and business models, their returns on capital and growth accelerate upwards. We're not very imaginative. We call them accelerating. And then they turn into compounders, which is quality growth stocks, really. High returns on invested capital, high rates of growth. Unfortunately, competition is out there. Fade happens. So there's a very powerful tendency for excess profitability and growth to then fade over time. And IBM is a poster child of it. It's still a very good business, but its returns on capital are fading due to competition, and it is struggling to grow. After that fading phase, companies become mature. They're still okay businesses, accounting profits, but no excess return on capital, and they grow about GDP. Unfortunately, even from there, mature businesses and industries can come under immense pressure around obsolescence from competition or changes in the world, and their returns can go below cost of capital. They might be loss-making, and their revenues could even shrink. So this cycle of innovation and disruption drives returns and growth up, and then competition, maturity, and obsolescence drives returns and growth down over time. Now, what we do at the beginning of our investment process is we allocate every company in the investable universe into one of these 5 life cycle categories. And it's a differentiated analytical framework that we use to give us an edge in both stock picking and also in how we construct portfolios. I won't have time to go into that in huge detail, but in essence, what we've done from a stock picking perspective is we've created 5 stock picking approaches inside the same manager. You can think of life cycle as a little bit like style, everything from early stage growth disruptors, quality growth, contrarian GARP, value, deep value. And in essence, we've spent 25 years now refining 5 different stock picking approaches, recognizing that how you pick a winner in each of these categories needs a completely different piece of analysis. So it's like having an early stage growth stock picking approach inside the same manager with a deep value stock picking approach. And we're looking at different things when we do that. We've actually been able to develop those different stock picking approaches such that we've added alpha in every single category over the last 10 years, having refined and worked out how to pick a winner in each category. Now, the second thing we do is we then use life cycle again to build life cycle diversified portfolios. So we know how much of the index is roughly in each category, and we populate our portfolios to life cycle neutrality. And when we do that, effectively for the investor, we've taken style risk off the table, or a very, very large amount of style risk off the table. It's this combination of stock picking and this nuanced approach to 5 processes in one, but also taking style risk off the table, which means that irrespective of whether it's a growth value or a value market or an up market or a down market, we've been able to keep driving that stock picking alpha irrespective of the style environment in which we've been. So that's a basic introduction to life cycle as both a concept, but how we use it to give us 5 stock picking approaches inside the same manager, but also build ultimately a very balanced portfolio. Moving to a couple of stock examples, just to maybe bring that stock picking to life. There's a company in the compounding part of the life cycle which we own called Sire. This is a North American trucking business. It actually does something called less than truckload. So it's not, don't think Amazon parcels, and don't think huge containers that go on container ships. It's pallet-sized deliveries for customers. Now, as a quality growth company, we know that you make money when you buy quality growth stocks when they compound their success better, faster, and longer than the market anticipates. And although this is in a relatively industrial-related industry, we've been able to establish through our stock picking approach for quality growth companies that there's wonderful network effects with the way they run their business. As they increase the density of their network, they can drive more revenue, but at incrementally lower cost because trucks have to drive less distance, and there's less expense and less capital needed to generate incremental revenue. So there's network effects in how they work as a distribution model, and as a result, their growth is actually at higher margin and ROIC than all of their historic business because of those network effects. In addition to that, they've only got 5-6% share in a hugely fragmented market, which means, what do we like in growth stocks? Well, they can triple, quadruple, quintuple their market share through market share gains for many, many years to come, which is also a great thing for compounding growth. So here we have a wonderful business model that has network effects to drive returns on capital up and a massive runway for growth. When we go to something like a turnaround, like Delta Airlines, which is not in this high-quality growth part of the life cycle, we've also looked at the business model, and we've also looked at the end market conditions. But this time, what excites us is completely different. So there's no network effects here that are of any substance. It's a relatively commoditized industry. But instead, Delta are employing a completely differentiated strategy where more than half of their revenue actually comes from premium travel, very wealthy baby boomers and business travel in the US. And they're basically not really that focused on economy travel. And as a result, they can get differentiated margins even though they're in a commoditized industry. And there's also interesting supply-demand dynamics in what they do as well, because this is a really tough industry. And when you're turnaround investing, one of the things we've discovered over many years is that it doesn't matter how good the strategy or management are. If the industry is terrible, don't worry about buying the turnaround, because it's very, very unlikely to turn around. So when we've analysed the external environment here, we've not analysed growth potential and market share and things like that, because it's a terrible industry. Well, actually, but what we have noticed and what we like in turnarounds is that there's a supply deficit of pilots, airplanes, landing slots, and infrastructure in America for the next foreseeable 5 to 10 years, which is fantastic, because even if someone wants to destroy the airline market profitably, they can't, because they can't get any planes, pilots, or landing slots, which sets up for the first time in about 40 years an amazingly interesting industry dynamic, and we know that is critical when you're picking a turnaround, and we can find the evidence here. So 2 separate examples, 2 different parts of the life cycle, but I hope it brings alive the subtle nuances and the difference of the factors we're looking for to pick a winner. I talked about how we build a diversified portfolio, and this is an example of our diversified portfolio. And you can see on the slide on the bottom line there, the active weight by life cycle category. So these are some of our best ideas from our diversified portfolio. But the key thing is we build life cycle diversified portfolios. So it doesn't matter if it's growth stocks on the left that drive the market, we're there, we're roughly neutral. And it doesn't matter if we get a rotation into value stocks that drive the market, we're there, we're roughly neutral. And in both cases, we've focused on owning the best stocks within that zone of risk. And it's that balance that can drive outperformance across multiple market conditions, irrespective of what happens. If I now move to some of the insights, for those who get to know us, we pretty much think about everything through the life cycle, including our market outlook. So we've structured it as such. I just wanted to flag up that we don't really do top-down, but we do notice a lot from the bottom up. We're bottom-up stock pickers, and we can begin to aggregate some really interesting opportunities and also risks that we can see in markets from the bottom up. So our outlook is more of a bottom-up informed, what are we seeing out there, thinking in clusters of risk, and we've highlighted on the slide. So at the front end of the life cycle, AI, when we look at the business models here, there are genuinely some unbelievably interesting models here that truly could change the world. And our focus is on finding the ones that actually will versus the ones that won't. But it, from our perspective, is a very real phenomenon, not to be ignored and not to be written off as hype. The danger in this part of the life cycle at the moment, though, is that there is a lot of hype, and potentially in certain areas or certain stocks, there is genuinely a lot of valuation risk. So when we're in this part of the life cycle, there's some real things going on that are creating wealth and potentially quite cheap still, but there's also a lot of hype and valuation risk to watch out for. In the compounding quality growth part of the life cycle, tech as a quality growth compounding zone is pretty well established in the price. And what's interesting to us is we're finding a whole series of non-tech business models that have learned to enhance the advantages of data and network economics to generate an ability to super compound. Sire is an example of that. It dynamically prices every shipment based on knowing where every parcel is within its network and every truck is. So it's using technology to drive massive logistic network efficiencies, but also pricing power. And there's a whole series of non-tech compounders out there that have embraced tech to create an element of super compounding in both their quality and their growth. We also do notice in compounding that there are actually a lot of businesses out there, like I guess your classic blue chips, that are quality stocks, but they don't have any growth. So a lot of consumer staples are like that, and they trade at quite high multiples, but without the growth, it's not really justified. When I get to fading at the moment, right now as we see it, there are a lot of cyclical opportunities, quality cyclical opportunities out there. We are noticing companies that are really quite good and are going to have a cyclical downturn when it arrives, but the market has already begun to worry about that a lot, and it's very much priced in. That's a really interesting area of potential opportunity. It feels a bit like getting ahead of the cycle, but a lot of cyclicals of high quality nature are looking very cheap at the moment. And also in fading, we are noticing some companies that look interesting initially as faders, but the more we dig, the more we realize that as globalization unwinds, what might have made them a compounder for 20 years is actually a real problem. You know, if you're a consumer business with 40% of your sales in China and you're American, or vice versa, it's a difficult headspace in this part of the life cycle. So watch out for deglobalization at the stock level as a structural threat to businesses here. In mature, a bit like was discussed in one of the earlier presentations by Antipodes, there definitely are big pockets of mature value and significant valuation anomalies in this part of the life cycle we're noticing out here. But there's also business models that are at risk from inflation because they've got no pricing power. And then finally, in turnarounds, there are some fascinating turnaround opportunities we're seeing in places like Japan and Europe. But we also noticed that having not had a credit crash for 15 years, we're a bit wary of credit risk at the stock level in this part of the life cycle, because I think a lot of people have forgotten what a credit crash and credit cycle might look like, because we haven't had credit risk for a long period of time. So that summarizes a bit of some of the big themes, opportunities, and risks we're seeing out there from the bottom-up level. But the point about the way we run money is that by having a life cycle balanced approach, we're able to look for alpha opportunities across this entire set of opportunities, maximizing the alpha opportunities for the clients, and then by balancing across these different categories, creating a portfolio with very low style risk and volatility and the potential to outperform across multiple market conditions. As I said, it's something we've now done for 20 years with an unchanged process, and we're now in this, what we think is a really advantaged structure of the multi-affiliate Pinnacle model. And it's for that combination of the experience, the platform we're in, the structured process built on these frameworks, and the track record that gives us the confidence to drive the repeatability of what we've done in the past and look to do that going forward. So thank you very much for the chance to get to introduce Lifecycle to you, and enjoy the rest of your lunch. Thank you.